You may have seen the amount of free money that's available from the government or low interest loans that are available for your business and be wondering, is it time to refinance? Hey, I'm Justin Hitt with Sustainable Wealth Secrets. Now, in this podcast, I'm not going to talk with you about who to refinance with. I'm just going to talk with you about the logical conditions necessary to consider before you refinance. But if you're holding any debt, your cost of capital, which is how much it costs to have that money, factoring in inflation and opportunity cost, you are ultimately paying for every loan in more ways than just the simple interest rate. And so when the Federal Reserve lowers rates or there's other opportunities to borrow at a lower interest rate, you must logically consider how to approach that opportunity, which may lower your payments, reduce the amount of interest you pay over time, and ultimately help you apply more of your cash flow to wealth building rather than the losses that you'll take in holding excessive liabilities. Now, what does all that mean? Well, in plain language, is when you owe people money, that is a negative interest obligation. That means you're paying for the privilege to get money now and pay it back over time, rather than having money now and being rewarded for investing that money. Now, when you look at these opportunities for interest with COVID, for example, COVID is allowing folks to withdraw money and take loans from their 401k accounts. It has government programs set up to help certain types of businesses or certain types of individuals. If your employees are off and they're getting paid unemployment, you have a negative proposition of not having the available labor to generate revenue. But you also have the liability of rehiring later when people get back to work. There's a lot of factors involved. So if you're looking at these different plans, what do you look at before you borrow? First off, you want to make sure you have clean and accurate bookkeeping. Clean and accurate bookkeeping will give you an idea of what financial position you're in, because for a business to borrow money when they have no money is a very dangerous proposition. So you want to consider, what will my cash flow be now? What will my cash flow be in the worst case scenario? And what will my cash flow be with these loans? So does the business adequately produce a profit in order to cover the obligation of the loan itself? So in some cases, shutting down your business, taking a couple years off, and then turning your business back on later is a very good solution. Sometimes, engaging a specific slice of your customers is a good solution. Also, maybe how you run your business, fundamentally changing your business. All these options need to be considered because you want to make sure you get the right amount of financial support, because a loan is not it's not a grant, it's not a charitable gift. It's a loan that you'll have to pay back. And anytime you borrow money, you're under specific conditions of that loan. So you become obligated, in fact, enslaved by the loan. But if you borrow the money and have a high utilization value, you're able to generate free net cash flow. And you're able to use that money to keep the business going in a way that will pay that money back easily, then very often it's a good deal. But what are we looking at? If you're going to use debt to refinance, does the new debt reduce your overall payments and improve your cash flow? Improved cash flow will allow you to reliably pay down that debt. Are the interest rates comparable? If you have a 10-year loan at 5% versus a 5-year loan at 3%, it is possible for the 5-year loan to have a higher payment, which reduces your cash flow, even though you'll pay less interest, where you could have took the 10% loan and paid the higher payment on the 10% and actually reduced your overall interest paid. So are there scenarios other than borrowing that would put you in a position where you're debt-free faster? Now, it's not all about being debt-free, because very often you can convert liabilities to assets. In the case of a house or property, let's say you live in a big house and you find that the rental market is strong around that house. You can actually move to a smaller house, buy a smaller house, move to a smaller house, rent out the larger house, and have someone else cover your mortgage and liabilities associated to the other property. That will also give you depreciation on the property, which could lower your overall tax position. Now, again, I'm not a tax attorney. I'm not a banker. I'm not your financial planner. talk with your financial planner. The key of what I'm sharing with you here today is that when interest rates are low, we have to step back a little bit and ask the question, how can we leverage this opportunity to increase our wealth? And it comes down to building several scenarios. So let's say you've got thousands of dollars in your 401k program, hundreds of thousands of dollars, and you can borrow that money at 4%. And there's a extremely long payback term, and you don't have to worry about a lot of things there. You would then say, okay, well, what's the scenario? What if I borrow the money? How will I apply the proceeds? What if I don't borrow the money? How can I adjust my current debt reduction plan? If I do adjust my debt reduction plan, how will that impact my overall cash flow and total interest paid? And then you may even want to look at a scenario of what if I do nothing? Based on my current situation, if I do nothing, what is the outcome? Now, this does sound like work, and it can be a bit of work, but it usually ends up being a couple sheets of paper. Each page outlines a scenario. Then you run some back of a napkin type of analysis, and then you can start narrowing down the possibilities. You can borrow money from local banks, regional banks, national banks. You can borrow money directly from the government through the Small Business Administration. You can borrow money from your customers through a prepayment scheme. So let's say your customers normally buy $10,000 of services over the course of the year, and you have a good margin on those. But if you get the cash now, you can upgrade equipment so that you get an even better margin. So you might offer the customer 12 months of service for 10-month cost. So you're actually discounting the customer because they're paying a chunk of money up front, a prepayment program, rather than paying over time. And you can show them how that actually benefits them. You can put them in a VIP program. You can have guaranteed delivery because we are having supply chain challenges right now with COVID. And this would give them what they want and give you a large chunk of cash up front that you could set aside into, if you have a copy of our cash parking plan, you could park that cash somewhere in escrow and actually generate a revenue off of the cash itself while improving your overall cash position so that you better qualify for loans or lines of credit with vendors or to purchase equipment that increases your profitability or your productivity. There's just a number of factors to consider. Now, what are some mistakes that people make here? First off, I'm hearing it constantly. People are contacting me and they're saying, I'm getting $500,000 from this PPP program. I'm getting $500,000 from these government loans. And, oh, wow, our business is shut down, but all this paperwork we've been doing. And I asked the question, with your existing cash flow, that means your discounted cash flow due to this event, are you able to pay back the loans? And they're like, no, that's why we're getting the loans. I said, no, listen, if you can't pay back the loans now with the money you have, because a lot of these loans, you're going to have to start repaying them in a year. What if this situation continues for a year and you've further depleted the business? And maybe you had, a little bit of extra cash. So you were you bought some equipment thinking things were going to get better and then it didn't get better. Now you're stuck with equipment. Ultimately, a big mistake is not building out the scenarios. You have to realistically build out these scenarios. The money will wait for you. In fact, a lot of folks are going to go out and get loans. Their businesses are still going to fail, and then you can buy the same assets at a discount because folks are going to make mistakes. They're going to go get a big bonus at the end of the year, and they're going to buy a boat with a bonus. And then 5 years later or 3 years later or 2 years later, they're tired of the boat and all the extra expenses, and you buy it for pennies on the dollar. In fact, I had an opportunity to buy a $125,000 boat, yacht, beautiful boat, $125,000 used, and that was the appraised value. That's what the broker said it was worth. But my buddy's like, hey, look, you give me $40,000 and it's yours. And I said, well, is this a special deal for me? And he's like, no, anybody shows up with the money. Because what he was looking at is he'd sell the boat through a brokerage for $125,000. The brokerage will get a certain fee. He'd have to wait, of course. There were a number of upgrades that the brokerage suggested would improve the sale of the boat. It's not guaranteed to sell. It was better for him to get $40,000 today than $125,000 later and possibly still net out less than $40,000. So you want to look at present value. It's a mistake to ignore the present value of money, getting the money today versus getting the money over time. In the case of debt, you want to look at any terms. I've seen so many folks tell me, oh, I got this loan from the federal government and I found out it has this clause that said if I don't follow these guidelines, I've got to pay this back. I said, well, that's how loans work. But the guidelines are very intrusive. And for their particular type of business, they don't want the government in those details. And they didn't really get the concept that there's no such thing as free money. Another mistake people make is when they do the scenarios is they go with the best, most glorious scenario without running it by their financial planner, their CPA, their tax attorney. Because, for example, let's say you borrowed $100,000 in the marketplace, beautiful interest rate. You borrowed it as a personal individual, and then you put some of that money into your business as an owner contribution. You use some of that money to refinance personal debt, because a lot of business owners have personal debt, and you use some of that money to maybe cover a rental property. Well, there are 3 different tax scenarios here, and you might have been better borrowing the money inside the business and borrowing the money directly attached to the house or property on the rental side, and borrowing your individual coverage as 3 separate loans, because your tax a liability. The loan inside the business has the interest is taxable. It is tax defer. You don't have any taxes on it because it offsets your income. Inside of the rental, similar concept, but personally your taxes are not tax deductible or not tax deferred or anything like that. Ultimately, you might have been in a better situation not to borrow the money in the first place. Maybe you could get yourself in trouble by borrowing 3 different loans and they all have short terms, and now your payment is tripled rather than one loan that has much longer terms. Now, I worked with one client, and what they ended up doing is they took a large loan in the business, paid out owner contribution, which helped the owner cover their business debt or their credit card debt, and then they were able to free up the payments on the credit card and use that to apply towards the rental activities. It's a very common model, but you really got to look at these scenarios. Taking the large loan in the business and paying out shareholders or stakeholders is a better position because it makes it better tax friendly. But the business has got to have the cash flow and has got to qualify in order to make the payments on the loan itself. You can get this stuff all gobbledygooked. While I'm not a financial planner, while I'm not your tax attorney, if you have those people on staff and you still want to talk with somebody about cash strategy, including how to park cash to make it work harder for you, ways and strategies to leverage cash in the marketplace to gain more customers. And I really like we didn't get a chance to talk about it, but I really do like the business development side where you leverage a small amount of cash that you have to generate new sales with customers and really self-finance through customer acquisition and customer retention plans. And we can talk about that. But if you want to talk about any of these things, you want to visit me at www.sustainablewealthsecrets.com. Ask your questions, and I'll be happy to either answer your questions on another program or we can get together for a consultation and talk about your specific situation. Again, I don't offer tax advice. I don't offer investment advice. I don't offer those things, but I can speak in an intelligent manner with your CPA, tax attorney, the folks that are more familiar with your unique situation. Now, if you don't have those people on hand, I suggest you find some. But if you don't, we can still talk about general strategy and high-level techniques, including additional mistakes that folks make when it comes to acquiring capital for their business. I want to thank you for listening. Again, I'm Justin Hitt with Sustainable Wealth Secrets, where we help you transform what you do to keep more of what you have and produce great wealth that cannot be taken away. Thanks for listening.